sales in our lifetime. So you can't keep that up. It's going to adjust. You know, there's going to be a lower volume at some point. So it's not bad that it went down. This is a thing from Zillow, and this is kind of a chart showing where they were expecting prices to go. And the blue areas, they're expecting prices to go up. Not a lot, but they go up. And in the red or orange areas, they're expecting prices to go down. And it's really based on I think that next slide here. I'm sorry. I thought we had another slide. Anyway, the red areas are where people are leaving. Like right now, there's a negative growth here in California. Right? So when you have more people leaving than coming in, well, things are going to slow down somehow. But other states like Texas and Florida are booming. They're growing. They're not showing any slowing in people moving there at all. So that's, you just have to take a look at your markets. There is a slight drop, but again, this is very, very slight drop in rents. You know, we're talking about 0.5%. And that's nationwide. And my experience has been, because I've been doing a bunch of stuff in Florida, rents have not dropped at all in Florida. They didn't even going up. So it depends on what market you're in. But also take a look at the fact we've had these crazy high rents, right? And if there's some job layoffs or a little bit of a slowdown in the economy, people can't afford those crazy high rents anymore, so it's going to drop. But again, as long as the unemployment numbers stay stable, which they're looking very stable right now, I'm not too worried. And again, we can all debate, you know, where interest rates are going to go, but we'll see what happens. But if they go up much more, it's going to be a problem. If they just kind of stay in the range they're now, I'm not too worried. I think we're going to be fine. And again, this is housing supplies. So the housing supplies is kind of down, which means that we need more inventory for the number of buyers. So that's a good sign for real estate. Also, there's a lot of large institutional buyers that are still buying a lot of assets. Believe it or not, there's a lot of big funds that are buying single-family homes. Maybe not in California, but they're buying a lot. I know in Indiana they're buying a lot. Vegas they've been buying a lot. And so they're seeing what I mentioned earlier, that the numbers are working better on the single-family rental than it is on a multifamily. And so there are some really big institutional buyers out there, and they're still very active. In fact, their activity in the last year went up as far as the number of single-family homes they buy. So that's helping the market. All right, so let's kind of keep going here. Anyway, nobody has a crystal ball. You know, I don't think it's a horrible time we're in right now. I think we have to kind of be smarter about what we're doing. And again, you know, you got to keep in mind that we're going back to a normal real estate market, right? Waiting several months to sell a property is normal, right? Selling a property in a week is, not normal. So everybody has to just readjust your mindset and understand that. And again, going to this kind of market, it's a little more fun because you can actually wheel and deal, and you can actually get some things done that you couldn't have done before. But in the end, as an investor, you got to take a look at what market you're in, what kind of property you're buying, and what kind of rent can you get for it. Because in the end, again, I've been through several crashes. They were painful, not fun. And I saw people who made a lot of money lose it real quick. But the ones that were fine were the ones that had good, stable rent income, right? Because if you have a multifamily property and things get bad and you lose a couple tenants and you're leveraged up to the hilt, right, you go negative really quick. So I'm not a big fan of debt. You want to keep your debt relatively low because, again, if you go into a downturn and you lose some tenants or you have to lower your rents, you want to make sure you keep covering your expenses. You don't want to run negative. And if you have a lot of debt, you run negative really fast. And that's what happened in 2009 and 10. A lot of people had this very high debt, and it didn't take much for them to run negative and go under. It's different. The banks were much smarter since then. People are putting a lot more money down on properties. There's a lot more equity today than there was back then. So I don't think we're going to go through the same thing. I just rewatched the Big Short. If you haven't seen it, it's good to watch it again and just kind of remind yourself what happened there. But that same thing's not going to happen. They didn't do those kind of loans. People are not leveraged out to 98%. of that property, like it was. Everyone I've been dealing with, you know, to buy a property in the last, you know, 5 or 10 years, you had to put 20, 25% or more in. So people have much more skin in the game than they did back then. So I just don't see it. And again, ultimately, the job market is still pretty strong. There's some layoffs happening right now, but it's still not a big deal. Oh yeah, and then the other thing is, you know, if you hold a property long enough, it always goes up. So if you get into a property, as long as you can keep that cash flow coming in off your rent and be in a market where, you know, you can sustain the rental income, you're going to be fine. Most people aren't buying to turn around and sell in 2 years anyway. You're buying it for the next 5 or 10 years. So as long as you get the cash flow you want, you're going to be fine. The market will go down, it'll come back up. But it always recovers, always. It's just a matter of how long that happens. Oh yeah, this is a slide I was looking at for earlier. The blue states are where people are moving in, and then the red states are where people are moving out, the net flow of people. But you can see anywhere down here in the south, you know, especially Texas and down in this area. We do a lot of stuff in Indiana. Indiana's middle, you know, it's still growing. It's just not as big as the other states. Oh, and this is just showing how, you know, when we had the crash back in 2008 or so, LA dropped quite a bit, came back up. Right now it's down a little bit. But again, we're coming off of a crazy peak here, so it doesn't surprise anybody that we're going to have a bit of an adjustment. But then you look at some of these other markets like Houston, they had a bit of a dip back in that same period, and but they didn't have a big drop. Also Indianapolis, we do a lot of stuff there. They had a bit of a dip, but nothing dramatic. Anyway, I'm going to go through these slides really quick. We do a lot of properties in Indianapolis. There we're doing mostly single-family homes. These homes you can buy anywhere from $90,000 to $120,000, believe it or not. They're fully renovated. We work with a team there that renovates them and rents them out. And they have management on site there. And those are actually doing very good. And even though, you know, you're hearing things here, the Indianapolis market is just a very stable market. And we've done other properties there too. We've also done triple net lease properties. We've done some shopping centers, but mostly single family. And again, these are all these numbers. You can expect around a 8% cash flow off a property if you buy one today in Indianapolis. We're also doing Airbnbs there. We have a team that does goes in and does the you know, the design team that puts all the furniture and everything in there, and a group that specializes in managing Airbnbs. I don't know why, but Indianapolis has been the best Airbnbs we've seen. It's just a great market there. There's just a shortage of hotels, and we buy these larger homes, you know, like a 4-bedroom, a new home, new downtown, and they rent really fast for Airbnb. They do really well. But yeah, if you're doing an Airbnb there, you can expect about a 15% cash flow, which is great. We're also doing Airbnbs in Albuquerque. That works really well there too, because Netflix has a huge studio there, so there's a lot of traffic between Los Angeles and Albuquerque. And so we've had good success with Airbnbs there as well. So we work with a client, you know, we find the property for you, you can buy it, and again, we have a team that'll put in all the furniture and design it for you, and then another group that specializes in the Airbnb leasing. Beaumont, Texas, we've done a lot there. We're just doing another transaction. Again, here we're doing single-family homes. We're working with a man that lives in LA, and believe it or not, he has 150 homes in Beaumont. And yeah, and so every once in a while he'll say, look, I want to sell 10 of these and buy something else. And so then we'll have our investors buy them. This market is super stable. It's the largest oil refinery in the world there. It's about 2 hours east of Houston. The job market there is fantastic. It's going to be fantastic for many, many years. No matter what happens, the rest of the economy, they're expanding and adding to this oil refinery there. And there's anyway, whenever we put a property in here to rent, 20 or 30 applications the next day. Never a problem, and we've never had problems with clients, tenants here. It's been great. So these homes you can buy for anywhere from $120,000 to $250,000 each, and they're good properties, and they've all been totally renovated, and we have a management team locally there that will do all the management for you. In fact, a lot of my clients have never even gone there. Same with Indianapolis, actually. All right, and there's the numbers. Florida, okay, so right now because of the hurricane, we're doing a bunch of stuff south of us, actually Sarasota and south. I apologize, I need to have a bit better slides, but Florida's still one of the #1 states for people moving there. Here in California, it's maybe not, you know, as obvious as it is to people on the East Coast. I grew up in Canada, and everybody knew would go to Florida, you know, for spring break or something, right? And so everybody in the Northeast knows Florida really well. So it's a great market there for Airbnb. It's a great market for rentals, and it's also a great market for a lot of people retiring. And you rent a lot of people that will buy a second home in this area, and they'll live in it half the year, and the other half they rent it out or something. But it's just a really strong market. And because of the hurricane, there's a lot of great opportunities. Oh yeah, it's showing the population growth. Yeah, everything's looking so positive for Florida, and the prices there, they hardly dropped at all with what's going on right now. And here you can get homes anywhere from 150 to 350 that are great homes for doing just regular rentals or Airbnb, and they both work really well there. So yeah, we're doing a bunch of those. Here we're showing a home. This is one that someone else I know worked with ended up doing. They bought it for $140,000. It's going to be about $75,000 fixing it up. This was a property that got beat up in the hurricane, and anyway, the guy decided he didn't have enough insurance to do what he wanted to fix it up and move out. So this property, they're going to be into this for probably about $210,000 to $220,000, and it's easily going to be worth in the upper 200s when they're finished. And that'll take about 6 months. So if you're interested, we have a program where you can buy a property, and we have a contracting company there that'll do all the fix-up and everything for you, and then you'll end up with a property under market. And then you can either turn around and sell it, or you can rent it out, whatever it is you want to do. And like I said, Airbnb works really good in this area as well. And then one other thing here, I'll get out here. We also do a lot of these manufactured homes in Houston, and we have an arrangement with a group that owns about 35 manufactured home parks, and you can buy a home for anywhere from $50,000 to $70,000 each, and you own it, and they have it in the park, and they manage it for you, and you're going to get about a 9% cash flow off of that. And 9% is after all your expenses. And it even comes with a home warranty program where all the fix-up and everything is covered by the home warranty program, so you won't have extra little things. And also they have an arrangement where after 2 years, if you want to get out of it, they'll buy it back at the same price you bought it for. It's guaranteed in the contract. So this works out really well. You know, the manufactured homes, you're not going to get appreciation on them, but you're going to get great cash flow. And so when you mix it in a portfolio for somebody, it works out really good because this will end up being their highest cash flowing asset. And again, if you want these slides, just let us know. We'll be at the back here. And we also do property tours, so if you guys want to sign up and be in our database, usually once a month we take a group of investors somewhere to one of these sites, and you can go kick the tires and check out what it is we got to offer. But yeah, so that's been real popular. Okay, and then like I said, we do triple net leases. Those are for usually larger transactions. Yep, we actually did that In-N-Out burger right on the 10 that you cut by. That was a good one. Anyway, so yeah, we have a lot of but here's a transaction we did last year. A client of ours sold 2 triplexes in LA. He was netting $88,000 of income. He went into a triple net lease outside of Indianapolis. He did some manufactured homes in some of those houses in Beaumont, and his income not quite doubled, but went up quite a bit. So that's the kind of stuff that we do. We kind of mix and match, you know, the different products we're talking about depending on the client. And again, the goal is to give people higher income and some diversification in their portfolio, and be in markets where we feel confident. So I'm going to wrap it up there. If you guys are interested, you know, come to the back, or you know, right across here. We'll be at our booth and answer any questions. And we've got flyers, and you can sign up for our database. Yep.
How often do people that buy through you actually physically go out to see the properties before they purchase, or do they just do it from the information you have?
I would say maybe a third go to look at the property. I'd say over half have never seen their properties. surprisingly enough. Well, you know, it's so easy to go onto Google now and look at the neighborhood. I swear, you can see more in that than you do actually going there half the time. And we can do photos and everything of the property. And so, yeah, you get a lot of information that if you didn't want to go there, you don't have to.
Yeah, so if,
Oh, one quick question, Linda. Yeah.
I just had a question about depreciation and intentions of an investor to hold long-term when you're diversifying like this. It goes to the investor a lot, but would a cost segregation analysis be beneficial?
Oh, well, you have to look at how much it's going to cost to do that. On a single-family home, it's not worth it. But if you have a commercial building, it's definitely worth it.
Some of these.
Yeah. And cost segregation is a whole nother subject. You can do an analysis of, you know, I did one on a property, a commercial building I own in Clearwater, Florida, and I got a $120,000 write-off on it. But it costs like $5,000 or $6,000 to get that study done. So unless it's a bigger property, it's probably not worth it. I think they wanted me to get going there. One quick question.
Okay, so going back to the map of the U.S. where you had the migration, you know, the red and the blue and the green,
Yeah.
how did they come up with that map? Like, what type of data were they using?
Who came up with it?
How did they come up with it?
Oh.
Where did they get the data from?
You know, I don't know. My guy in my office dug it up. I'm not sure where he got it. I think we have it sourced on the slides if you want to get them. We can get that for you. Okay, we're going to end off here and then we're going to go. Thank you so much.
Excellent, John.